Welcome back to the Deep Dive. Today, we are jumping into the latest economic sources. And honestly, this might be one of the trickier weeks we've had to unpack in a while. I mean, you look at the surface, right? You've got markets hitting absolute record highs. The Fed finally moved on rates after sitting tight for months. And retail sales, they look really strong. But then you dig just a little deeper, and the numbers, well, they show this incredibly divided picture, almost like two different economies running side by side. It feels like a moment of real cognitive dissonance for everyone involved.
Right. Let's start with the big one, the Fed. They finally cut rates 25 basis points after 5 meetings of just holding steady. Now, the cut itself wasn't a huge shock. The market pretty much expected it.
Yeah, it was widely traced in. But what's really telling, I think, are the mechanics behind the decision, like the vote count.
The vote count.
It was 11-1, which sounds like strong agreement, but the fact that it wasn't unanimous, that actually sends a pretty significant signal that there isn't total harmony inside the Fed right now. It suggests there's at least one influential voice in there arguing things are slowing down faster than the majority is ready to admit publicly.
And Powell's language after the decision, maybe that was even more important than the cut itself. He kept calling it a risk management cut. He said, there's no risk-free path.
Right. And that phrase, risk management, what risk are they actually managing? Is it jobs slowing down, or is it the risk that they've kept rates too high for too long and might tip us into recession?
It sounds like they're hedging their bets.
I think it's likely both, but the emphasis on risk suggests they're trying to get ahead of something. They're looking at the global picture, the job market softening, and they're easing just a little bit, kind of preemptively, to maybe avoid a really hard landing. It feels more defensive than, confident.
And that lack of confidence seems baked into their own forecast too, right? That famous dot plot.
Oh, absolutely. The dot plot just confirms how uncertain they are. The spread of opinions on where rates should go next, it's pretty bewildering, actually.
How so?
Well, you look at the plot, right? It maps out where each member thinks rates are headed. You've got 9 members who see maybe another 50 basis points in cuts for the rest of 2025, okay? Relatively dovish.
Okay.
But then you've got a pretty big group 6 members saying, nope, we're done after this one. No more cuts.
Wow. So almost half think they're done and half think there's more coming.
Exactly. And then you have Moran, our dissenter, way out on the dovish end, forecasting cuts of 125 basis points.
125.
Yeah. I mean, that's not just a little disagreement about timing. That shows a fundamental split on where the economy is even heading. They can't agree if inflation's really tamed or if a recession is knocking on the door.
That kind of division makes it super hard for markets to figure out what's going on. But for now, it seems like investors are betting on more cuts.
They definitely are. Our sources show about 74% of investors expect 50 basis points total in cuts this year. Only about 25% are siding with the one-and-done camp or less. So yeah, the market is pushing for the Fed to lean more dovish.
But how can the market trust that when Powell himself basically said, look, we're taking this meeting by meeting, and admitted it's challenging to know what to do?
That's the million-dollar question, isn't it? That kind of language really doesn't scream confidence or certainty.
Which makes the next batch of economic data even more crucial. Everyone's waiting for Friday's PCE price index, right? The Fed's preferred inflation measure.
Absolutely critical because unlike the CPI, the PCE tracks what people are actually buying. It adjusts when people switch, from beef to chicken because prices went up.
Right, substitution.
Exactly. So if that number comes in hot, suddenly these risk management cuts look a lot harder to justify. The Fed's wiggle room disappears pretty fast.
Okay, let's shift from the Fed's uncertainty to what's actually happening on the ground. Consumer spending. The headline retail sales report looked great. Came in at plus 0.6%, way better than the 0.2% expected. Matched the month before, too.
Yeah, on the surface, it suggests people were spending quite freely over the summer, even with some signs the job market might be cooling off.
But this is where it gets really interesting and maybe a bit concerning. That headline strength, it hides a pretty major disparity, doesn't it?
It really does. This is the key point, I think, for you to really grasp today. We're genuinely looking at a two-speed economy. All that momentum in retail sales, it's almost entirely being driven from the very top.
By the wealthiest consumers.
Precisely. The strength is being propped up by the wealthiest households, and their spending is directly fueled by, the very strong stock market we're going to talk about next.
Okay, give us the number. How concentrated is it?
Get this. The top 10% of the income distribution, they accounted for a staggering 49.2%, almost half of total consumer spending this summer.
Half, just from the top 10%.
Half. Think about that. 1/10 of the population driving nearly half the activity. And apparently that's the highest concentration we've seen recorded since 1989.
It's 1989.
Wow.
That's historic. But wait, if nearly half the consumer economy is basically tied to how the stock market is doing, isn't that incredibly fragile?
That's exactly the point. It creates this huge potential point of failure for the whole economy. For the last year or so, the narrative has been the U.S. consumer is resilient.
Right.
But this data really suggests the story isn't about the U.S. consumer. It's about the wealthy U.S. consumer. Their ability to spend is directly linked to their portfolios hitting new highs.
Okay, so if the top 10% are powering the spending, what about everyone else?
Well, they're basically just trying to keep up. The data shows the bottom 80% are just about managing to keep their spending level with inflation. They're not really buying more stuff.
Just paying more for the same stuff.
Pretty much. They're running just to stay in place. They don't have that extra cash, that discretionary income to really drive broad economic growth.
So if the stock market sneezes,
Exactly. If the market corrects and that top 10% pulls back even a little, there's just no cushion from the bottom 80% to pick up the slack. That could lead to a slowdown, maybe even a sharp one.
okay, that reliance on the wealthy consumer tied to the market, where is that wealth coming from? Because looking at the stock market lately, you wouldn't think there was a worry in the world.
Right. U.S. stocks, well, most of them anyway, small cap value being the exception, have just been hitting record after record. The S&P 500, growth stocks, the NASDAQ, all closed at new peaks recently.
It's been relentless.
And what's really fascinating is just how fast the gains have been and how narrow the leadership is. That performance, especially in the NASDAQ, it points straight back to one thing, AI. The tailwinds from AI-driven stocks just keep getting stronger.
So it's not like the whole economy is booming and lifting all stocks.
Not really. This isn't some broad, fundamentally driven rally across 500 companies. It feels much more like a high momentum trade focused on just a handful of these mega cap tech names.
Although we have seen some signs of broadening out, haven't we? Like small caps have done really well since August.
That's true. There has been some rotation. Small cap stocks, which tend to be more sensitive to the domestic economy, they've actually outperformed large caps quite significantly since early August, up something like 13.3% versus 7.0% for large caps.
And even just in the last 5 days or so.
Yeah, small caps were up 2.4%, and the NASDAQ was right there too, up 2.0%. So there's maybe a bit more risk appetite spreading, but the core engine is still very much AI.
And the scale of the money pouring into AI is just mind-boggling.
Absolutely staggering. Just last week, think about those announcements. NVIDIA putting a massive $5 billion into Intel.
Which sent Intel stock soaring, 23% in one day?
In one day. Just on that news. And then, as if that wasn't enough, NVIDIA also pledged to invest up to $100 billion into OpenAI over time.
$100 billion.
That kind of capital commitment just reshapes markets. It creates this incredibly exclusive club at the very top.
The $3 trillion club.
Exactly. We now have 4 companies with market caps over $3 trillion. NVIDIA, Microsoft, Apple, and now Alphabet, Google just joined them.
Alphabet got in after those favorable court rulings on the antitrust stuff.
Right. Ease some of that pressure. But think about that concentration. 4 companies holding that much value, almost entirely built on the promise of future AI breakthroughs.
So this incredibly powerful but maybe fragile rally in these few stocks is generating the wealth for that top 10%, which is then propping up almost half of the consumer spending in the entire economy.
That seems to be the feedback loop we're in right now. It's powerful, but it rests on a very narrow foundation.
Okay, if the stock market is signaling this extreme, maybe AI-fueled risk appetite, what are other assets telling us? Let's start with gold. It also hit a new high.
Yeah, gold crossed $3,700 for the first time. And what's really unusual, as you pointed out, is that this is the 4th week in a row it's hit a record high at the same time the stock market is surging.
They usually move in opposite directions, right? Risk on versus risk off.
Typically, yes. So when you see both surging simultaneously, it tells you something interesting. It suggests that even amidst the stock market euphoria, some serious money is hedging its bets.
Meanwhile, the bond market wasn't exactly cheering the Fed's move.
No, bonds were actually down for the week. They were clearly hoping for a much stronger signal from Powell about future rate cuts, more clarity, more commitment.
They didn't get it.
They didn't get it. So because of that disappointment, yields actually went up. The yield on the 10-year Treasury rose almost 11 basis points to close at 4.14%.
And rising yields mean falling bond prices.
Correct. The market's basically saying, okay, Fed, if you're not going to promise us more cuts, we still need a higher return to hold this government debt. It reflects that lack of clear dovish guidance.
And looking globally, this record rally was mostly a U.S. story.
Largely, yes. Developed market stocks outside the U.S. were actually down slightly, about 0.4%. They didn't really join the party.
And exceptions.
Japan was a notable one. Their market hit a new record high, crossing 45,000. And emerging markets had a pretty decent week, too, up about 1.1%.
But while markets are focused on AI and Fed signals, there's a big political risk brewing right here at home, isn't there?
Oh, yeah. We have to talk about the looming government shutdown. That deadline, October 1st, is getting awfully close.
And given how fragile we just said, the consumer situation is so dependent on that market wealth, a shutdown seems like the last thing we need. And there's no sign Congress is close to a deal.
Our sources suggest very little progress is being made. So let's try and wrap this all up. It's been a really complex week to synthesize. We've seen the Fed make this very cautious, internally divided decision, this defensive risk management cut. At the same time, you have this incredibly powerful but very narrowly focused stock market rally driven by AI hype. And crucially, we've seen hard data showing the U.S. consumer base is deeply split, with the entire retail sector's health basically resting on the stock market staying buoyant for the wealthiest Americans. So the immediate focus, it really shifts now to that PCE inflation number on Friday. And frankly, whether Washington can avoid shooting itself in the foot with a shutdown.
Yeah, we've definitely established that these record market highs, they're built on AI momentum, and they're fueling spending by the wealthiest group, whose fortunes are, in turn, tied right back to those same market highs. It's a very circular thing, because right now they seem to be the only engine keeping things going. Something to definitely think about as we watch the political drama play out next week.